G'day everyone and welcome back to this Share Cafe Hidden Gems webinar. We always appreciate your time on a Friday lunchtime. Be aware we've also started another webinar series which is every second Tuesday. It's called our due diligence series and each week we take a deep dive into one company. It's a 45-minute event. Last week we looked at Lake Resources. It was very successful. So keep an eye out for that single company webinar every second Tuesday. Now, don't forget to ask questions. As I always say, the CEOs really appreciate the line of questioning. They learn a lot from questions. Now, first up, we're talking potash. And surprisingly, the most popular article we've had all year on Share Cafe has been talking about potash. And I find that quite odd, to be honest, but it's a topic that is really resonating with retail and institutional investors at the moment. So first up, we have Kalium Lakes, ASX code KLL, market cap of 183 million, a flat return. The company is an exploration and development company focused on developing the 100% owned Biondi sulfate of potash project in Western Australia. We have with us the CEO, Rudolph van Niekerk. Rudolph's in the middle of the desert out in WA. We're hoping his internet connection stays with us. Over to you. Thanks, Rudolph.
No worries. Thank you, Tim. Thank you also for having us there. There was a couple of communication interruptions as you were doing the introduction, so let's hope it all goes well. So Kalium Lakes, we're building our Biondi sulfate of potash project in the Northwest Pilbara region. If you don't mind to skip over to slide 4 of the presentation, I can do a quick overview of where we are. Next one. Yeah, that one's fine, thank you. So Biondi sulfate of potash project, we are located about 240 kilometers southeast of the mining town of Newman. Newman is about 2 hours flight just north of Perth, or if you feel like taking on the road, it's about 1,200 kilometers up the Great Northern Highway. We are in the final stages of commissioning our project that is getting ready to commence commercial production of sulfate of potash. Sulfate of potash we'll talk about as a macronutrient in fertilizer. We'll talk about that in a bit more detail in one of the following slides. But we are producing this sulfate of potash, also more commonly known as SOP, from extracting the sulfate of potash from brine resources. So we extract the brine from underground via either a shallow lake aquifer or deep paleo channel aquifer. We pump it through a series of evaporation ponds where we evaporate off fresh water content within the brine. That leaves the minerals behind. We then harvest and we put through a purification plant to remove the remainder of impurities and produce the SOP. We source this brine from underground using pump stations, so either production bores or trenches, and it's a fairly straightforward and simple process, really. Construction of our project is virtually complete, 98%. We're just doing the final stages of product commissioning, getting our plant up to chemistry concentrations, and we've spent about $280 million on the project to get it to where we are today. Our process design is quite unique. There's no one that has produced potash in Australia before, so we have had to go internationally to find the right engineers and process knowledge, and we are using a German company called Ecto. It's a joint venture between two groups who is providing the process design and also the key process equipment. It's a small operation. We would be having 30 to 40 people on the site during steady state operations, producing at about 90 to 120,000 tonnes per annum. If you don't mind to skip over to the next slide. Just a few key numbers. I won't talk about all the tiles there, but earlier this month, we have achieved a significant milestone where we have produced, as part of commissioning, our first batch of SOP. And as I said, we are getting our plant concentrations up to the desired rate so we can very soon begin with commercial production of SOP. We've got a very long mine life, not that common for projects in Australia to have 50 years of mine life or more. So quite a long-term opportunity and investment here. Not everybody knows, most people in the industry does, that SOP is 100% imported to Australia, so we would be looking to change that. by being the first producer of SOP in Australia. Global market's about 7 million tonnes per annum of SOP. And if you look at our mine and reserves, we've got 5 million tonnes in reserve. It gives us about the 50-year mine life, but just on reserves, we have 88% of our first 30 years of the mine life is based on reserves. We touched on the capex and 98% complete. Offtake agreement, we'll talk about that in the presentation, but we have an offtake agreement in place with a company called K+S or Kalium Salts. They're based in Germany, and outside of China, they are the largest SOP producer in the world. And under this offtake agreement, they will take 100% of what we produced up to 120,000 tonnes per annum on a take or pay basis. We've got very attractive and low-cost debt funding through NAIF, Northern Australia Infrastructure Facility, and also with KfW IPEX, which is a German arm of KfW for international project export funding. Attractive NPV, 484 million, and we've got some really good SOP price forecast, in particular for the next couple of years, lying ahead. If you can go to the next slide, please. A few achievements for us. So we have been building this project for the last 2 years. We've mentioned our first SOP production earlier this month. Very excited to get into commercial production very, very soon. We've completed the project within the capital expenditure budget of $280 million. We have hit every single milestone on the project schedule since May last year. So very proud of the team. We're not a big team here, but they've certainly delivered the project very good on project and on schedule and on budget. We are also starting up at the right time, right place. In Australia, with having to import all of its potash, but at the right time because SOP prices are really good at the moment, and we'll talk about that in some of the coming slides. We touched on the long life, and we will also talk about our expansion plans to go from the 90,000 tonnes per annum production to 120. Go to the next slide, please. Worth just touching on the two key types of SOP, or most common types of SOP potash that is used in the market. The most commonly referred to as MOP or SOP. MOP, also known as muriate of potash or potassium chloride. It's a larger market, about 70 million tonnes per annum, where SOP is 7 million tonnes per annum, as we've indicated before. But MOP has got about 40% of chloride in content, and that chloride component is toxic to some plants. So typically, your high-value crops, fruits and vegetables, they prefer SOP over MOP. And some crops just can't deal with the chloride whatsoever. Chloride you can't get out. The plant doesn't absorb it. It doesn't go out of the ground. So very difficult to get rid of it once it's in the ground at all. There also is a price premium typically between SOP and MOP. SOP typically sells at about $150 to $200 US dollars per ton higher than MOP. If it wasn't for that price premium, anyone would prefer SOP over MOP. That price premium is largely driven by the relationship between MOP and SOP. So that relationship is really based on how about half of the world's SOP is produced. And that is done by a process called the Mannheim process. In this process, you will procure MOP as an input, or use MOP as an input with sulfuric acid. You will mix it at about 600 degrees Celsius, and then produce sulfate of potash or SOP and hydrochloric acid. And because of this secondary production process, or producing SOP as a secondary product, the biggest cost of that process is the cost of MOP. And because it's such a large portion of the world's production, about half of it, as I said before, it introduces this price premium between MOP and SOP. That's also one of the reasons why Kalium is such an attractive project, and it has such a great opportunity to get off the ground. It's because we're not a Mannheim producer of SOP, we're a primary producer of SOP, which just allows us to be in that lowest quartile of all cost producers on a global scale. So on the next slide, we have a graph that shows the price forecast outlook. You will see on the left-hand side the solid green line. That's the actual pricing that we've seen this year. Very, very steep trend upwards. That price increase largely driven by two factors. One is strong demand from farmers. We've seen some, record crop prices from good harvest this year, and all of those nutrients have been taken out of the soils and needs to be replaced. So very big demand for fertilizer in general, so not just SOP or potash. But then also we have seen the sanctions that's been put against Belarus, and that's significant because Belarus Kali supplies about 1/5 of the world's MOP, and as we've discussed before, MOP pricing has got a direct impact on SOP pricing. And with these sanctions that's been placed against Belarus, it has provided some limitation on their ability to export to the same areas, regions, and customers and routes as before. But it's also caused some uncertainty in the market where suppliers are looking for alternative sources of MOP. And all these factors have had a very, very strong impact on the SOP pricing. If you look at the price graph there, the forecast is based on the consensus that was done for us by CRU and Argus. And you'll see that we are looking at, when you see SOP prices above $550, $600 per ton, those are good prices. That's sort of where you want to see the price range. Once you start dropping below 450, that's the lower range of pricing. So we are seeing quite a healthy price forecast for the foreseeable future, really. So a very good time to start up a new project in this industry. So on the next slide, just a quick summary of some of our ESG credentials or highlights. Firstly, SOP in general, because you get the higher yields per acreage and you don't have the chloride. Just in terms of deforestation, you get the benefit of the lower carbon footprint. In terms of what we produce, typically potash as a fertilizer produces about 0.46 kilogram of carbon emissions or carbon dioxide per kilogram of potash produced. In our case, we're almost half of that, so only 0.26 kilograms. So very good statistic there as well. Because most of our energy that we use is solar evaporation in the ponds, as we go through the slides, we will show you that as well. I'll have to speed up a little bit. About 96% of our energy comes from solar evaporation. It's just a process plant that runs off the gas engine. So we can go to the next slide. I'll quickly go through the different steps of the process and where we are. So a very simple process. We extract our brine, as you can see from the photo at the top left. We put that through a series of evaporation ponds where we evaporate off the fresh water. That crystallizes out the salt. That salt is then harvested, which is the photo on the top right. And that harvested salt is then put through the purification plant where we produce the SOP, which is then trucked to Perth. We can go to the next slide. There's a photo of our trenches and our bores. On the right-hand side photo is the production bore. On the left-hand is the trenches. You can see in the left comments, we've finished everything that we need to do for the 90,000 tons per annum, and a few extra bores we've got to add to increase production to 120. We'll go to the next slide. That's just a photo of the ponds. Everything we built and need for 90 is in place. You can see the trucking and harvesting process happening there. And to go to the 120,000 ton per annum expansion, we just need to add a few ponds on the left and the right-hand side of the trains that you can see there already. I think I've got 1 or 2 slides left. So the process plant, just a few construction photos. You can see our rum stockpile where we are feeding the salt. Don't have any wet photos there. Should have added a few wet photos. You can see in the front page of the slide, but lots of salt being processed in the plant to get our chemistry levels right up at the moment. The last slide, we've got a haulage solution in place. We talked about the backloading. To commence, we'll put the product in bags on site, and we will use the empty trucks that comes past our front gate back to Perth, those trucks that service all the other mining companies in the Pilbara, to take our product back to the depot and to the shipping port facility in Fremantle. So I think the next slide is just the project financials. I won't go into the details here. You can see our NPVs, IRRs, returns, all-in sustaining costs. We've got an upside there where we're looking at a potential reduction in the mineral royalty, which we are negotiating with the WA state government. And we're also hoping to see some easing of some of the pressures we're seeing in costs as a result of COVID. Schedule, we've talked about our first production that we've achieved. We're looking to ramp up to nameplate within the next 6 months and then getting to that 120 expansion level by the end of next year. And in the meantime, we will continue with some value-adding opportunities, which we haven't got covered in too much detail in this presentation. So that's it. We are at the stage of our project. We are substantially de-risked. We're getting ready for commercial production. We have commenced our expansion plans to be at 120,000 tonne per annum production level by the end of next year. We're working with world-class partners, not just on the technical level, but also with our financiers and our offtake partners. We've got a very long life mine, attractive economics, and we've got some great growth and value creation opportunities as well. So that's it.
Thanks, Rudolph.
Thanks, Tim.
We've got lots of questions. We don't have much time, but I'd appreciate if you could probably type in some of the answers to these questions so you can answer them live. Now, BHP made a over $5 billion US dollar investment in potash in Canada. How has that changed the landscape for potash?
BHP has been trying to get that project going for a very long time, and if you look at the presentation that they released on the back of that announcement to proceed, you will see that it's also on the back of some strong forecasts on pricing, and also because by 2025 you start to see that supply demand ratio is getting out of balance. So you've got a demand increase that outgrows your supply capacity. It's not likely to impact the SOP market significantly, because by the time they will get into production, you will see from their forecast they are just supplying a market demand that would be there and ready to receive the product. So it's a big project. I don't see MOP really competing with SOP in that space. And
there's a question here: with the current price of SOP, are there any plans to hedge the product moving forward?
Look, we are hedging as best as we can. It's not necessarily that easy to hedge the product, but we are working on trying to fix prices as best we can and lock in contracted sales with some of the larger buyers in the industry. So with our offtake agreement with K+S, we actually get the benefit of the end customer price, and we share the cost of shipping component between where we deliver CFR Australia and to the customers. So not that much of an opportunity to hedge, but certainly in the next 2 years we are looking at a pretty strong forecast for pricing.
And is there any plans to have solar as your source of energy out there, given ESG requirements from the investment community these days?
We are certainly looking at those opportunities, in particular for the more remote pump stations, for the bores and trenches. Looking at different options at the moment, looking at whether we put a renewable wind turbine in place with overhead lines to feed some of the bores, whether we go solar with battery power. So we haven't talked about that too much in the market, but that certainly is something we're working on in the background to see if we can add further value to the project.
Great, Rudolph. That's all we have time for. It'd be greatly appreciated if you could answer some of these questions live. There's quite a few of them continuing to come through, but we're out of time. I'm sorry.
No worries. All good. Thank you, Tim.
Thank you. Next up, we welcome back Cirralto, ASX code CRO, market cap of around 171 million. The company is a transaction services business supplying industries with a broad range of B2B payment services, digital trading software, and integrated solutions. We welcome back Adrian Floate. Adrian, nice to see you. Thanks for your time.
Thanks, Tim. Good to be here. Good morning, everyone. As my name suggests, I'm Adrian Floate. I'm the Managing Director of Cirralto, and we are the owners and developers of the Spender platform. And Spender is really a platform that connects buyers and sellers, enables them to manage flows from sale through to invoice, through to payment and lending. And I suppose what that really means for us is that we're a software company and we're a payments company and we're a lending company and or a fintech, which is difficult at times for people to get their heads around. So if you wouldn't mind transitioning the slide, Tim, that'd be great. Thank you. I guess for me personally, this has been a very long journey where we've taken the collective learnings of a really strong team, and we're bringing to market, I suppose, solutions to the common problems that exist within a business, from how they sell to how they collect money, their cash cycles, etc. But probably the thing that sets us apart is our ability to connect value chains together. So we've got a really strong offering for a retailer to connect to a consumer. And then we get really interesting when we allow that same retailer to turn around and trade with a wholesaler or a distributor. And then again, with a distributor back on into a manufacturer. And then for primary production, looking at farm inputs like fertilizer and chem and other sort of different kinds of structures. And I suppose for us, collaboration is really at the heart of what we do. And it's probably the thing that gets us up in the morning and excites us, is our ability to create new ways to share data and transactions. And those transactions often result in, amazingly enough, a payment event. So for us, digitization and the digitization of business has had a real kick along through COVID. And we can probably almost stop talking about that now, because now the world's starting to open up. It's pretty exciting to be looking forwards to normal again. But what has happened is the world's looked at how it will operate, how it wants to collect funds, how it wants to make sales, raise invoices, and share that data through, if you like, the business framework. And that's what we're really good at. So we're to business like what WhatsApp is to communications, where we allow those standard transaction types to be shared end to end. And that gives us incredible insight when it comes to lending. And obviously we've been announcing recently new innovations around buy now, pay later. We've got a really exciting development we've been working on with cross-border buy now, pay later, which we think is enormous. And so, look, we've come off the back of our best quarter. If you wouldn't mind changing slides for us. Really sort of transformative stuff for us. So if we do nothing more for the rest of this year, we'll have 100% growth plus, which is not bad. And obviously we don't plan to do nothing more for the rest of the year. We had really good revenue growth in this quarter, cash receipts growth. The interesting thing around that is our buy now, pay later revenues and some of our lending and payments revenues really didn't get a big Guernsey, because if you like, when we transact, we don't see the revenue for 30 days from the invoice. So we're really pleased with the outcomes that we got in the most recent quarter. We're obviously well funded. We've made announcements around utilizing more of our balance sheet to expand our lending and payment rail. And I guess as an organization, the really key thing for us to understand is, I guess for the market to understand is, we selling is not really what we're about. We view ourselves very much as a global technology and a global solution. And to that end, we're really focused on how we build structures to, if you like, expand our capability and expand our services outside of Australia. So we recently announced an acquisition with Green Shoots, which, in turn with our debt warehouse works has really established us, with a footprint for where we want to go into Asia and then more broadly overseas. So I suppose the numbers we're throwing off at the moment are very much what we would see as being our walk phase of our commercial development. We've sort of really not pushing the envelope extremely hard on revenue, and we're probably just coming to the end of that cycle now. So it's a really pleasing time as we come into the end of this year and look at some of those sort of big lick numbers we've got, and then keep that momentum going. So if you wouldn't mind changing slides for me. I guess looking at it in a longer term sense, we have managed growth at about 36% quarter on quarter for the past 7 quarters. We've obviously been heavily focused on really solving 3 key problems to be that global business. So one is transaction scaling and and really release scaling more than anything else, so we can get more innovation and open up more markets faster. So the whole team's been building around, volume benchmarking and looking at, transaction per second scaling points, which we think is really exciting in terms of prospects, because when we look at the way we layer revenue, our ecosystem allows us to take, as an example, I'll use a retailer. Our retail offering, we can make really nice revenues out of bundling together point of sale, e-commerce, and payment service. But when we get really sexy and we can start putting some real sunshine between us and, say, a competitor like Square, is when we say to that business, hey, let's turn around and offer you a buy now, pay later facility. And when we do that, we can lower your payment service, but from an overall perspective, really double down on the relationship with that customer. So we start to build these incremental revenue points where payment might be worth 0.7% of flow. And so $1 million customer might be worth, say, $7,000. But when we add their lending over the top, or their buy now, pay later, or trade finance, we can add another 2% of 500. So as I say, we can double that customer. And it starts to get really easy to understand. The more you disconnect the payment coming from the customer to the wholesaler, and the better you control those flows, the more and more money you need to manage that flow between those two businesses. And I suppose to that end, we've done really well in establishing integration with the MasterCard track payment service. And that business payment service is really ideally built for multi-currency, financial services, early settlement discount. It really aligns very well to all the things that we've been developing as a core service, and gives us a great capacity to scale more effectively from, I suppose, very big enterprise customers down to small customers. So, that's been a fantastic outcome of the most recent quarter. As I said before, we've been establishing our debt warehouse facility. That's been really exciting works, and really the key for us is to build a bankable structure that takes us abroad, but allows us to, if you like, expand those domestic capabilities, which is super exciting. We're cornerstoning that with our own money, which has been, I suppose we're doing that for as long as we can. For as long as we can max out our returns using our own balance sheet, we will. But ultimately, what that debt warehouse facilitates is us to lend more, manage more flows, and I suppose we buy money wholesale and sell it retail. And we keep the bit in the middle as our revenue. The quarter's also seen a number of acquisitions that really round out capability and bolster us as a true transaction engine going forward. So as I said before, for us, it's all about shaping the way in which businesses trade. We see marketplaces and digitization of the whole sales lifecycle being at the heart of our opportunity. And we expect to continue to announce transactions in that space. And we're really excited to be completing green shoots, very, very soon, and really establish our Asian presence. We even see India as its own market. It's just a monster opportunity. It's many, many, many times bigger than the Australian marketplace, and as one person put it to me the other day, it's the IPL of e-commerce. There really is a massive opportunity to go along that digital wave in such a big economy with a fantastic team sort of at the cornerstone. So it's been an exciting quarter. It's set us up for the quarter we're having now, where we're really happy with how we've come out in October. And then, for us, it's all about putting those little key fundamentals in place to keep us growing through the back end of this year and into Q1 in 2022.
Thanks, Adrian. You ready for me?
Knock yourself out, mate.
Hey, there's a good question here. Can you tell us the clip you take from the payments during each part of the supply chain? How many clips can you take from the business, given you are following the transaction from the kind of manufacturer to the supplier to the retailer to the customer? Can you talk through how you get paid?
Yep, that's a good question. Okay. All right. So if we were to start off at the retail end and we were to do that, say $1 million of sales, we would at the gross end clip 1.5, but we'd report about 0.7. 0.7, anything from, so 0.7 is a good number to use. If we then turn around and look at lending, as per the Holler announcement, 2 would be pretty normal. So for us, but where that then gets interesting is if you blend buy now, pay later with card, you'd get 2 plus 0.7. So that single flow would be worth 3.4 on that transaction. And if you come the other way and we talk early settlement discount in the wholesale distributor, that could be another 2. And again, if we card blend, 2 plus the 0.7. So it doesn't probably matter where we play, the more we can effectively card blend. It does 2 things for us. It lowers the cost of funds to the buyer because it lets them use their interest-free days on their card. It also gives us payment certainty. And that's really at the heart of what our business is giving certainty of supply to the buyer and flexibility in payment and certainty of payment to the seller, so they're not sitting there holding the baby, as it were, with their stock gone out the door but no cash in the bank. So look, we can take a clip the whole way along. We'd obviously, from a maximization of capital perspective, we wouldn't be looking to take anything that was sort of less than that 2% position on a single flow. So that probably summarizes it really well, but generally speaking, we're 2 plus.
And so with the buy now, pay later offering, I mean, we know there's a lot of competitors there, but there's a fairly low participation rate. So there's the opportunity. Can you tell us how many retailers have signed up for that?
Oh, mate, it's changing every day. It's very difficult to give you that as a number. We now are reporting sort of on a weekly basis. So we're certainly adding customers 50 to 100 in a week at the moment. But yeah, I have to say, I take a more broad brush approach of it these days. There's too many names for me to retain, but just certainly growing very successfully. And hence, from a technology perspective, everything for us is about boarding. How can we take barriers to entry out? And that ranges from opening a service to also expanding a service. So a customer that's got a $5,000 facility, how do we, if they're giving us good telemetry, how do we automatically offer them 10, for argument's sake?
And with your acquisitions, is that based on, are you making acquisitions based on the technology you need to plug into your platform, or is it based on clients, or what's the premise there?
Well, it's probably a little bit from, there's a few metrics, but the first thing, obviously, the first test is, should we build it or buy it? And if we can get an advantage, because there's always gaps. You never have the perfect system. Everything's always evolving. So if we can get a speed to market advantage by buying something, and we think the teams will align to our culture, and we think we can sweat that capability and make more money, well, that's obviously going to be pretty attractive to us. But there's also ancillary benefits. So, if you look at green shoots, technology, yes, team, yes, but proximity to Asia, big bonus. So there's always ingredients that create drivers for transactions, and they're not the same 100% of the time.
Okay, and just time for one more. There's quite a few coming through. If you wouldn't mind answering some of those live, if you don't mind.
Sure.
Any expectations of when you'll be cash flow positive?
I would say we have enough working capital at bank to achieve that outcome. I mean, at the end of the day, we probably did exactly what we thought we'd do last quarter. We're investing heavily in expansion. When you invest heavily, it obviously costs money. As per like the mine establishment previous presentation. So it's not a million miles away. You can do the maths yourselves from a scaling perspective. The easiest way probably to get a range for it would be to have a look at how many facilities we might issue or payment flows we might issue using, say, 5 or 10 grand as a number. And that 2% metric, you start to see, it's not a lot of customers to kind of get to the end game. and it becomes fairly easy to accelerate if we eliminate some of that friction in terms of boarding, which is 100% about our focus right now.
Right, Adrian, that's all we have time for. Have a nice weekend. There's a couple of questions there. If you could answer online, it'd be appreciated. Thank you.
No worries. Thanks very much. Cheers.
Next up, we have Houston. We have ASX code HWH, market cap of around $60 million, 1 year return of up 216%. We have with us Andrew Grover, who's the executive chairman. Now, the company uses proprietary software, data, technology, and mathematics to help humans make better decisions, especially when most at risk. Andrew will provide an overview of the company's recently acquired business. I'll let you pronounce that. A company aiming to reinvent cardiac diagnostics using advanced AI. Andrew, over to you. Thank you.
Excellent. Thank you, Tim. So yes, Echo IQ is a fully owned subsidiary of Houston we have. So that's ticker HWH on the ASX. So what is Echo IQ? In simple terms, that we're using the power of artificial intelligence and big data to reinvent cardiac diagnosis. It's basically as simple as that. Can we move through the third slide, please? Excellent. Who is Echo IQ? So we're a company with a single vision to use big data and AI to help cardio diagnostics. We're acquired in June 2024 by ASX listed HWH, and basically we acquired a proprietary database and AI algorithms, which we're now building on top of. We have about 387 million shares on issue, market cap of about $62 million, $3.2 million in the bank with another $1.5 million in options coming in over the next couple of months. And our top 20 owns 52% of the company, so we're quite tightly held. And we've got a good, solid backing from our major shareholders. Next slide, please. So we're November the 29th at the AGM, we are rebranding from Houston. We have to Echo IQ. Our ticker will change to EIQ, and that's based on the commercialization of Echo IQ and where we want to go as a business going forward. We see it as an awesome opportunity to build a global brand and a global solution in cardio diagnostics. Next slide. So what does Echo IQ do and what are we focused on? Cardiovascular disease kills 3 in 10 people globally, so that's 30% of the population. We're developing applications that use which use current infrastructure. So we're not trying to change the way things are done. We're using standard processes now, and we're adding to and making it easier for people to or clinicians to diagnose what's happening. So the way it works is quite simple. You'll see the picture in the top right-hand corner. You'll see an echocardio machine. It's basically an ultrasound machine. And what that does is it takes measurements of different parts of the heart and also takes images of the heart as well. The first disease that we are targeting is aortic stenosis. Aortic stenosis is heart valve disease. So what happens with aortic stenosis is what the main valve which goes into the heart goes from an average of 3 centimetres down to an average of 1 centimetre. And what happens there is that the heart starts to work a lot harder and the patient ends up having a heart attack. Now, in today's world, they're able to fix that problem a lot easier than what they were able to previously. Previously, you'd need to use open heart surgery to fix the problem. Now, you can go through the groin, put a new valve in the heart, and you can go in on a Monday or a Tuesday, and by Thursday or Friday, you're actually feeling a lot better. You're at home and the problem's fixed. Next slide, please. So the main issue has been around actually diagnosing the problem. And what's happened previously is that there's a lot of patients are missed. So they're saying that there's about 30% of people within guidelines are not diagnosed. And this is happening because doctors and clinicians are rushed. They're not able to spend the time and the effort that they need to work out exactly what's wrong with a lot of their patients. So we're saying that with our AI and with our machine learning that we can help them diagnose and find a lot more patients a lot more effectively and a lot more quickly. And the way we're doing that is we have access to the world's largest database of echocardiograms. So NEDA is a company which was set up about 8 years ago, the National Echo Database of Australia, and that has about 2 million echocardiograms with about 200 million data points. And what we're doing is we're using AI algorithms to be able to write an algorithm which helps diagnose different heart diseases, and aortic stenosis is one of those, more accurately than what you're able to, what are humans actually able to do. Next slide, please. So the Ecto IQ database, which we have access to through Netta, we've got a 17-year exclusive access to that. And what that allows us to do is access the data through the echocardiograms of about 1 million Australians. So it's 1 million Australians, 1.8 million echoes, and we're able to use that data to write our algorithm. We've just signed up a second agreement to access Netta 3, and what that's allowing us to do is have a look at additional health records of those 1 million patients to once again help find structural heart disease and heart failure. Next slide, please. So basically, how does Ecto IQ work? So we have a machine learning and AI algorithm which we run across the data points of the echocardiograms to help find more patients. So currently, we believe that within guidelines, we can increase the amount of people that are found with these heart issues by 50%. And outside guidelines, we think we can increase that by an additional 50% on top of that. Next slide. So typically when you're looking at clinical studies, and we've actually just signed up an agreement with Edwards Lifesciences, which is a $75 billion NASDAQ listed company. Now they're the largest supplier globally of heart valves. Now their current turnover for heart valves is about $4 billion a year, and 3.8 of that is in valves for aortic stenosis. Now, their internal figures are that they leave about 80% of people untreated. So in other words, clinicians globally are finding about 20% of the patients that are actually able to be treated. The other 80% are being missed. So they've actually fully funded the clinical trial to test our initial algorithm at St Vincent's Hospital in Sydney and a second hospital to be named shortly, that we can test our algorithm to prove that it works. Now, we're not a standard medtech company. With a typical medtech company, you're out there, you're recruiting patients, you're looking for people who are prepared to take pills and tablets and all those sort of things. We don't need to do any of that. Because we're an algorithm which runs across existing data, we're able to look backwards and we're able to look on existing data which is in the marketplace. So, for example, with our clinical trial with St Vincent Sydney, we're looking at approximately 20,000 patients. We're going over their records for the last 4 years, and we'll run our algorithm across it, and we will find the patients who have been missed. They'll then come back in, get looked at by the clinicians and the doctors, and then based on that, we'll be able to prove that our algorithm works and it does the job that we say it does. Now, with a clinical trial, there's actually typically 4 stages. We're currently at stage 3. So stage 1, we've developed the actual algorithm. That's already done. Number 2, we've actually validated the study against an additional 330,000 records. So that's completed, that's published, that's global, that's out there in the marketplace now. So what we're now doing is a retrospective observation and a clinical study. So we're now going to get the doctors at St Vincent's Hospital in Sydney will actually do the tests and come back and say, these are the people that need to be looked at, these are the people who have been missed, these are the people who need to either have a valve or get some additional treatment. Next slide. So then the simple answer is, how do we commercialise this? Where does it make money? Who pays for it? Where do we go from there? And in our opinion, there's 3 solid answers to that, and there's 3 opportunities for us to get revenue. Now, the first opportunity is what I just mentioned with the clinical trial, and that's a retrospective view. So with the retrospective view, we can go to doctors, clinics, and clinicians globally, and we can go to them and say, you've got 10, 20, 30, 40,000, 50,000 records which you have for the last 3 or 4 years. We can run our algorithm across them, and we'll show you patients who you need to bring back in and need treatment. They've been missed. They've been underdiagnosed. As I mentioned before, Edwards, $74 billion NASDAQ listed company, believes 80% of people with severe Ionic Stenosis are simply not diagnosed. They're missed for whatever reason, or if they're found, they're too old to be treated. So we see a massive opportunity working closely with the likes of Edwards or potentially Medtronics or one of the major valve performers to actually go out there and find them additional patients. Now, a valve will cost between $8,000 and $20,000, so there's a fairly large incentive financially for the valve makers to want to find those people who aren't helped. There's also a lot of pressure on the hospital system, where somebody who hasn't had a new valve placed then has a lot more hospitalizations and a lot more cost based on the hospital system because they're not healthy. Where if they had a new valve, they would be a lot more healthy. The second opportunity is, and we've announced another agreement with this as well, is actually in the workflow, so integrating with the actual reports that the cardiologists see. So once you actually get the echo done, the echocardiogram done, the report and the images get sent to your cardiologist. Now, the cardiologist is looking at a report. We're working with Fujifilm Australia at the moment to actually get a button put on the report. That button will be the Echo IQ AI button. And what happens is you click that button and that will analyze the echocardiogram, which has just been done with the patient, and it will give you a risk profile based on the numbers and based on our AI algorithm. So we're not trying to replace the cardiologist. We're not trying to replace any current medical devices. We slot very nicely within the current workflow to make people better at what they do, which will end up saving lives. We believe that our algorithm doesn't leave anybody behind. If they're within guidelines, we find them, but on top of that, we believe we will find an additional 50 to 100% of additional patients who aren't found. With aortic stenosis, which is the first disease that we're tackling, or we have actually finished the algorithm, and that's what our trial is being done on. Typically speaking, a cardiologist would look at 4 or 5 measurements to determine if someone has aortic stenosis. With our algorithm, for that same disease, we look at over 100 measurements. So the human can't actually diagnose that amount of information, and we obviously can. And that's simply due to the big data and the 200 to 300 million data points that we have access to build and then to grow our algorithm and get it doing what it does. We have 3 PhD data scientists in the team and the team leader who are working on that full time. The final option is actually integrating into and onto the actual machine, so onto the machine which does the cardiogram. And as the scan is being done in real time, we can actually give warnings to the sonographer who's doing the scan to tell them they can keep going with the scan, there's something wrong here, and continue with it. And we can actually give them instruction in real time. We do see that a little bit away. That does need FDA approval. We are working with an FDA consultant now in the States. With the retrospective review, we don't believe we need any FDA approval. With the workflow and being on the reports, we're working through exactly what we can and can't say now. All good.
Thanks, Andrew. Thanks for your time. I apologise for not pronouncing Echo IQ, but I didn't actually have my glasses on me, so it didn't quite look like that at the time. Can you tell us about the privacy of the data that you have access to? Obviously, there's health benefits in understanding that data for the patient being contacted, but is there any issues in that regard moving forward?
So the data which we're using is all de-identified. So we don't have the identity, nor do we need it. So with the clinical trial, that's being done in a hospital by the clinicians, and that is identified because they're basically running it on their actual patients. But everything, all the data we have now, which we're training the algorithm on, is all de-identified data.
Understood. And is the target market the cardiac specialists, or can the devices kind of be standard equipment at all clinics or ambulances to kind of to speed up the process?
Not really ambulance. Echocardiograms are done in hospitals and in the actual clinics. So the target market is actually the clinics and the hospitals which have echocardiogram machines. There's about 80 million scans done per year globally. So it's a massive market with the opportunity there is huge.
And can you put a dollar on them, on what you're selling, a dollar value and the business model behind that and the size
Look,
of the market?
we've had the business for 4 months. We've made massive, inroads in the 4 or 5 months we've had it. We are working on that pretty hard at the moment. What we're basically seeing is that our first go-to-market product will be around the workflows and actually getting on the echocardiogram reports. When you have a look at doing that, echocardiogram in the States costs about $2,000. Now, if we're sitting on the report, we think the cardiologist is going to a certain extent have a duty of care, where they're going, we can do it a lot better than them and we can assist them, then they're going to need to click the button. So they're all paying for reporting software now. So we see our model as a SaaS model, so software as a service where it's a user pay. So if a clinic does 5,000 echocardiograms a year, we would look at potentially charging them $1 per time we run the algorithm. And the next year they do 6,000, they pay $6,000. I mean, mind you, some hospitals do 50 and 100,000. So if you look at the numbers there and see that there's 80 million done a year, and we're charging $1 per person to run our algorithm to better diagnose them, as explained before, the uplift is substantial. And also when you look at that, the uplift is substantial, but so is the actual revenue. So doctors and hospitals, I know we all like to think they're there to obviously help us, which they do, but they're also there to make money. So the more patients they make, the more patients, the more revenue, the more income they get. So we're seeing, $1 a click, you can do 20 million a year if you get some of the market. It's a global solution. There's no country which doesn't need it or can't use it. And in fact, the countries which, like in Europe, like Spain, Italy, where they don't quite have the same quality of cardiologists, would be more likely to use it. So I suppose in a nutshell, we're trying to give every cardiologist the ability to do what probably 1% of cardiologists globally can actually do. And that's diagnose people a lot better, quicker and more efficient.
Thanks, Andrew. Fascinating story. Good luck out there. Have a nice weekend. Love to hear from you again.
Thanks. Thank you.
Next up, we have Change Financial, ASX codes, CCA, market cap of around $39 million, 1 year return of minus 35%. The company is redefining the possibilities of payments and card issuing by providing innovative infrastructure and tools for building customizable payment solutions. We have with us the CEO, Alastair Wilkie. Alastair, over to you. Thank you.
Yeah, thanks, Tim. And hello, everyone. I'm Alastair Wilkie, Change Financial CEO. I thought I'd just provide a little context before we go into the presentation that Change was actually founded in 2015 as an Australian company. We listed on the ASX in 2016, but importantly, we operated in the USA and exclusively until 2020. It was at that point that we actually made a strategic acquisition as part of our global growth plans. So it's been a challenging year and rewarding too. And what I'll do is I'll just share a bit of corporate overview, give you a bit of brief outline of our product services, and then some insights to our financial metrics and commercial plans. So you could just shift to the first slide. Thanks, Tim. The next one, yep. Okay, so Change Financial is really a payment solution and service provider. And of course, as a global business, we continually monitor the market and assess the key drivers that are affecting our market. And banks and fintechs are really the main customers that we have in our operations. And they themselves have been driving a lot of technology modernization, like moving to cloud and SaaS, software as a service type model to effectively reduce their costs and also start to uplift their increased customer engagement through bringing new clients on board. And look, from a consumer point of view, which is also important to us, even though we're a B2B business, the preferences they've really been driving is around seamless digital and mobile payments. And the fundamental shift that we've really looked at in the last year or so has been to simplify that payments experience for both our clients and for their customers too. So just move on to the next slide. Thanks, Tim. So at the heart of our business is really two core solutions. So we are fundamentally, as a payments as a service and payments testing solutions are the two core products. And these really fit within what we call the banking as a service ecosystem. So we're a component part of the overall banking service that's provided to consumers. And we actually have two main solutions. The Vertexon is the integration of our US payments processing platform, and also what we've acquired in the last year from a local acquisition that we made in Australia and New Zealand. And fundamentally, that solution provides payments through virtual, physical, virtual cards, prepaid debit and credit. And along with that, all the necessary digital wallets and Apple Pays to give that good consumer experience. But at the core of our business in this particular software solution is actually transaction processing. I'll go on a little bit later on to talk about payments testing. It's a really important product to us, but suffice it to say that our payments testing solutions become a bit of a de facto standard in the market. We have over 120 blue chip banks, fintechs, and schemes across the globe that actually use this product. And I'll give some insights on that shortly. So we just move to the next slide, Tim. Thanks. So we've really positioned our business to capitalize on all the growth that we've experienced over the last couple of years. And we have a large and growing client base. So we have staff in 5 countries, managing 136 clients who actually have an average tenure of about 8 years with the business overall. And notably, we've added 10 new clients across 9 countries in this past year with our testing solution. So we've really leveraged our technology to provide scalable solutions and to our clients, and there are over 16 million cards that are actually processed through our platforms worldwide, and it can be offered in 99 currencies. And as you can see there, we do actually operate with and are compatible with all the major schemes, including MasterCard, Visa, and so on. And then next slide, thanks, Tim. So just taking a little snapshot of the products. So I've talked about the top layer, which is about what the physical, big digital, and cards are all about, but we are a service provider too. And the thing that we want to focus on is with our Vertexon platform is that I'd say it's a mixture and a combination of our US platform along with our acquisition of a global management card system in Australia and New Zealand. So we really continue to support all our on-premises customers, of course, who are mainly large banks, and we have actually transitioned our platforms into a functionally rich SaaS, a software as a service solution focused on the card issuing. So we offer loyalty programs, integration, connection to reward gateways. And as one of the previous speakers talked about buy now, pay later, well, this is some functionality that we've actually had in our platforms for a number of years. And I'll give you a little case study on that later. But what we really provide here is that we can provide the banks and the fintechs with the opportunity to deliver that buy now, pay later experience to their clients through their existing card schemes. So that kind of avoids them having to go out and set it up with Zip or Klarna or any of the large players. Program management services have become a really important part of what we offer to market. A lot of the sort of smaller banks and fintechs don't really want to run card programs themselves. They're a brand and they want to put their brand and their app out there. So we offer that service behind the scenes, and we can take some of that burden off them. That includes compliance if that's required. But it's really about our clients deciding what parts of the customer experience do they want to manage, and we can manage the rest for them. And as I mentioned earlier, we do continue to offer our on-premises software solutions to link into their banks, but primarily we're moving towards that SaaS model now. So next slide, thanks, Tim. So we just take a couple of use cases to maybe help illustrate what we do. Well, ME Bank is actually one of our larger clients. They actually have over 450,000 cards that are actually in operation in the business. They're a very advanced company relative to what they do in the market. They've been with us for 9 years, and I'd say they're probably one of the leading edge innovative digital technologies that they actually provide to their clients. They have 2 products. One's a buck card, which is a debit, and the other is a franc card, which is a credit card. And the really important thing about what they do is that they actually have a great onboarding experience. So when somebody phones up and actually asks if they can have a card and they go through the various KYC, they can, once they're approved, actually have a card up and running within 5 minutes. And that instant issuance into multiple digital wallets is really critical for them. And you can see that they do also offer all the main pay options like Apple, Google, Samsung. It's a really slick interface. And it's highly desirable to our existing clients, many of who want to deliver that same experience to their cardholders. And one of our major large clients is BDO Unibank in the Philippines. They're the largest bank. They have about 2.5 million cardholders running on our platform. They're also a long-term customer of ours over a decade, and they're a big user of our buy now, pay later capability, which is built into the solution. We have two products. One is Install Pay, which is a dedicated buy now, pay later card where every single transaction, coffees, movies, so on, goes onto that card, and that can be split out into installments. Then we have another major product called Major Purchase, and it's a similar product to what you see in Australia now through Westpac and Commonwealth Bank. It's run over the existing rails, but it's really aimed at large purchases, and customers can turn this large purchase into installments, and then they can decide on the frequency and the number of repayments. It's really up to the cardholder to control. So good examples of the sort of solutions that our clients are using and how they actually affect the consumer in the market. And then moving on, Tim, to the next slide on our PaySim technology. I'm going to discuss this amazing testing platform called PaySim. It's many companies, when they go through kind of moving cards into market, fall foul of inadequate, or let's say challenging, manual and physical testing on the rails, the networks and the schemes, how they take it to market. And they typically don't realize there's an error until a consumer is phoning them and actually asking them to help them because they can't withdraw cash from an ATM. Well, with the PaySim tool, we can do all that testing virtually. From a desktop at home, you can simulate ATM and POS terminal transactions. And it allows banks and fintechs to really stress test all of the iterations of the potential transaction faults. And PaySim can actually simulate over 69,000 transaction iterations, which is why it's such a widely used product. And so for managing a card program updates or launching new payment solutions, the banks and the fintechs can reduce their time to market and also allow their teams to work remotely, which, as you can imagine, during a pandemic has been really important to them. But to give you a real example of where this is used, if you actually want to join the FPOS network here in Australia, you are actually required to use our PaySim solution to test, to certify, and then pass those results on to FPOS before they'll actually allow you onto their network. And so all the banks and fintechs who operate currently on the FPOS network are actually our clients currently. So I'll just give you a quick insight into the financial and commercials of our business. You're excited, Sam? So from a revenue point of view, I'm really looking at FY21 here. We're pro forma because of our acquisition was $8.5 million US, around 10 million Aussie. And that includes an annual recurring revenue from our license and support of 4.5 million from our existing client base. And from a product perspective, you can see the split there of 60% on Vertexo and 35% on our PaySim technology. And we have some other products, but we don't really promote them in the market other than through partnerships. And from a regional point of view, then Southeast Asia and Oceania have contributed over 70% of our revenues in FY21. And our other two focused regions in the US and Latin America are gaining momentum now as we're going through the strong and focused growth plans for this year. And we've just listed our top 10 clients there, and that contributes over 63% of our revenue and income. But that will start to mold as we move forward and start to bring on board new clients. And of course, all of the further financial information for those that want to have a look at it is available either through our website or on the ASX. But I want to just talk a little about our sort of go-to-market and strategy. We've come through a foundational and transformative year. And one of the things we did during that last year as we integrated the companies was really take a long, hard, strong look at the market on a global basis now. So we did actually work with Deloitte's global payments practice, and we completed an immersive session to develop a global go-to-market strategy that really looked at how we identify the drivers and impacts that are creating all that significant momentum in the payments industry that's causing this disruption. We got them to look at and examine what our capabilities were and what our global market opportunities were. And in addition to that, we had them validate our product roadmaps for both Vertexo and PaySim. And then, of course, we need to know what the competition was doing. So we asked them to do some work on insights for that particular plan going forward in terms of who is our competitors and how do we compete with them. And in doing so, what we did is we completed this 3-year strategy, which was to be competitive this year, to be different, and to be famous. And of course, our focus right now is on this year. So we're really focused on enhancing our payment solutions to grow through banks and early stage fintechs as our primary targets for the business. And that's effectively building on the sort of our core capabilities that we have inside the organization. Next 2 years, we'll focus on continued growth in the 4 main geographies globally that we currently operate in, and very focused on that. In terms of key highlights for our business on the next slide, then in this first quarter, we've delivered on a number of our key business priorities we set up last year in our go-to-market strategy, and that really was about accelerating revenue and client growth this year now that we've stabilized the business. So to operate our business in the US market, we do need to do something slightly different, and we finished in terms of who issues and who we work with. So we recently concluded a contract with Axiom Bank in Florida, who's going to be one of our major partners in the US to help us deliver new business into that region. And on top of that, we also secured one of our first new fintech clients in the US shortly after that. But one of the main things we did, as I indicated earlier, was really to combine our platforms, and we completed some great major milestones in that integration. And not only did we integrate all the platforms in record time, we did it on budget and in time, but we also we brought that up to a stage where we've now launched that into to a cloud environment here in Australia, and we're capable of actually taking that into any other regions within a matter of days and lifting that up. So one of the key things we've also been doing is looking at our staff and our board. So we've recently strengthened our board in Australia market, and that's just been recently announced. And from a brand awareness point of view, well, we've actually been really busy trying to get our all things new done in our business, and well, we've actually made some big strides to increase our PR and our IR, and perhaps today is really all about that. And just looking at some of the sort of last quarter, how it's all come out for us. Well, we did actually recruit 4 business development managers over the last 8 months and put them in positions around the globe to really address that focus on the client sales and revenue growth. And green shoots have arrived miraculously. So we've now just secured some new customers and new opportunities in terms of implementing our solutions globally. And as you'll see from there, we did quite regularly report on our growth in terms of pipeline growth, and you can see that we've had a substantial 273% growth in our pipeline, which is very healthy, and we're looking forward to a really great year. And we've done a number of things around implementing, technology to ensure that we can manage our pipeline and watch that growth go. So from a partnership perspective, just to complete on that, then we do have over 13 partners in our business, and we're just going through a renewal and looking at all that, how we get some more indirect channels to market. But as I keep saying in my staff, it's we have great technology, great processes, but it's the people that make it work. So we've also spent this last year really strengthening out our C-suite, and you can see some of these amazing guys with the right technology, commercial and financial experience to really push the growth through for FY22. And that, thanks Tim, is the end of my little pitch.
Thanks, Alastair. Congratulations on such a massive global footprint. Can we go back a step and just kind of simplify this payments process at the moment? I mean, I buy a coffee, I tap on, and I'm being charged 6 cents. Who's taking that 6 cents? Is that the bank? Is that you guys are on a software as a service model? So I'm assuming it's not you. Is it your competitor? How is that all evolving at the moment?
Sure. Well, in the instance you're talking about, Tim, remember, we're a business-to-business provider, so we provide the solutions at this stage, and the banks implement it, and they are the key interaction between the consumer and the bank. So they'll be collecting the 6 cents. And to answer your question, we provide them with the solutions and the services, and we charge them fees for that. But to take that question to the next level, we've recognized that we can bring more value to our customers by offering a lot of the services that they currently do themselves. So to help them reduce cost and outsource a lot of that, we will start to take some of that on in a software as a service. And in doing so, what we will do is actually then start to pick up on that annuity and the transactional revenue as well. So we will, at one point in, and we're already commenced this now, we do it in the US for some of our operations there, where we actually do take a clip on the ticket in terms of transactions, rather than actually provide the software solution and support and maintenance. So we're moving very much into where the market wants to go, which is that we are sharing in the responsibility, but also taking a clip on each of the transaction.
Understood. And is the opportunity here, because we often hear this, and I know potentially they're your customers, but the technology within the banks isn't efficient to provide this. So you're providing a white label service to the banks.
That is correct. Yeah. So they can start to outsource a lot of what they would have as internal technology and computers and systems and networks and so on. They can give all that to us, including some of the services to manage those clients. So yeah, so it's the way that the market's going right now, and this is what's really top of mind for a lot of our major clients. They want to reduce cost and improve the technology, and often because of the scale of them, they could take 2 years to implement some of these solutions and technologies, whereas we actually have built it and they can buy that from us and rent it from us and then implement it across their own platform, their own businesses.
And globally, where's your biggest opportunity at the moment?
Well, good question, because part of the global strategy that we did with Deloitte, in fact, identified that we have 4 main regions. As you can see, we're placed well to do that, but Southeast Asia, Oceania, US, and Latin America, which to us includes South at this stage. These are the 4 main regions that we are actually deliberately focusing on. And to answer your question, we see massive opportunities both in Southeast Asia and in Latin America. Why? Because there is lacking infrastructure, but a lot of people have mobile technology. You know, the mobile penetration far exceeds what they would have by way of infrastructure, and that's what our clients want to deliver banking services and payments through these technologies. So those 2 regions are significant to us in terms of growth, and that's beginning to show up right now relative to the growth in our pipeline too.
And is it all about growth? I mean, at what point are you profitable? And can you talk to what sort of growth you expect to see in the first, the next 1 to 3 years, rather?
Yeah, look, we're obviously behind the curve right now. We're heading towards that break-even point. It's difficult to give you an absolute accurate picture, and I suppose the guidance on that would be a bit sensitive in this call, but we are driving towards that break-even point. And also, for growth is extremely important, because we've spent the best part of last year actually integrating people, processes, technology, and now this is we're going to market, full growth, full client acquisition, revenue growth in different areas. So we're looking at growth in line with market conditions. We should be growing if the industry is right by 30-40% per annum. And if for the right companies like us, that should be well above that. We've seen some growth in the hundreds of percent. There's no reason we can't do that other than the boundaries of our own capacity. And we can figure that one out quickly.
And is it, from your competitors' perspective and from change perspective, is it a bit of a land grab out there at the moment? And do you see this kind of jigsaw coming together through acquisitions?
Well, in the market, I can see acquisitions being a part of the story. And in fact, interested in what Adrian was saying earlier. I think we've got some of what he wants, and he may have something we need. So maybe there's a chat going on there. But
I'll organise that for you.
Yeah, thanks, mate. But yeah, look, I think acquisition is a key way to go. For us, we've just completed one within the last year after our cap raise. I don't think that's necessarily on our immediate horizon, but it's not something we're going to forego. We have other markets we play in. So it's about organic growth. We've now got the tech platforms, we've got the people, and the things are set up and really starting to motor for us. So for us, it's about just making the growth happen as a result of the investment and time and people that we've actually put in the last year. So, yeah.
Thanks, Alastair. That's all we have time for. A great Australian story, and good luck out there.
Great. Thanks, Tim.
Thanks, everyone, for your time today. Have a nice weekend, and we'll see you next week.